In this week's video, we'll review the latest charts, data, and studies to help us answer the question, do the bears finally have an opening, or are stocks poised for a shocking rally? We'll be moving quickly, so feel free to use the pause button on your video player. We'll be covering events from this week, an update on our long-term research project, and we'll discuss the new client window, and we'll kick it off up here with a study about stock market performance following Fed rate cuts. We've discussed this topic in the past. The dates over here and the dates used in the study come from Ned Davis Research, handle here on X, aka Twitter. Moral of the story, if the Fed cuts rates rapidly and in big chunks, it's typically not good for the stock market because they are usually doing so to address adverse conditions. So if we use the dates from the left side of your screen, perform a study, we wanted to know, how did the S&P 500 perform walking forward in all cases? Let's start with the cases we want to avoid, the fast cut cycles. You can see there's a lot of red on your screen. How about the slow cycle cases where the economy was in much better shape? Answer, bottom of your screen. 1 month later, the S&P 500 was higher roughly 2% in every case. 3 months later, approximately 10% in every case. 6 months later, approximately 19%. 1 year later, every single case higher, approximately a 20% gain. And 2 years later, the median gain in the S&P 500 after the first rate cut in the slow cycle cases, 44%, with 3 of the 4 cases hitting the 40 to 65% mark. These are the numbers for the S&P 500. They look even more attractive for the NASDAQ. Average gain 3 months later, approximately 20%. 6 months later, approximately 30%. 1 year later, 38%-ish. And 2 years later, somewhere in the neighborhood of 50%, with every case higher. So if you hear you should sell stocks after the first rate cut, that's true if we're going to go into a recession, but it would be a massive mistake, historically, if we avoid a recession. So during the remainder of the video, we can look at the weight of the evidence and see which case most likely will apply if the Fed cuts rates as expected in September of this year. The next segment will focus on bullet point B, C, and D. You may remember from last week's video on Friday, the NFP report a week ago disappointed in the S&P 500 and the Dow tanked. And we noted, if you really looked at the employment report last week, it really didn't look that bad. Thus, our strategy coming into Monday was, let's just see if Friday was a one-day wonder. It was apparent that that was not going to be the case on Sunday night. On Sunday evening, when I went to bed, the Nikkei was down approximately 6%. And the thought process was, not that big a deal. If we wake up in the morning and it's down 3 to 4%, it's really a non-issue. Well, we woke up in the morning and it was down somewhere in the order of 12%. And it was noteworthy. At the close, it ended up being the worst single day performance-wise, percent change-wise, since the 1987 crash. And if you know your stock market history, anything associated with the 1987 crash, especially on a Monday morning, gets your attention. Concern number 2, right out of the gate, the VIX spiked up and hit 65 and change early in the session. If you know your stock market history and you know the history of the VIX, a VIX hovering around 55 before the market opens, again on a Monday, that's why they call it Black Monday, is concerning from a historical perspective. And if you saw this tweet, it doesn't say Chris Shavako thinks it's concerning. It doesn't say Shavako Capital thinks it's concerning. It says it's concerning from a historical perspective. And we can back that up with facts. And we did so just a few minutes later with this tweet. The VIX hit 65.73 after the open. The VIX hit that level intraday on October 10th, 2008 and March 12th, 2020. The only 2 cases in the history of the VIX dating back to 1990. If you know your stock market history, October of 2008 makes the hairs on the back of your neck stand up. March of 2020, not going to make you feel any better either if you know your stock market history. The S&P 500 had a drawdown greater than 30% during the COVID plunge. On average, after the VIX hit this level here, as it did on Monday morning, The additional loss in the S&P 500 was over 13% over the next 26 calendar days. And the concern was if the S&P 500, hypothetically, were to lose an additional 13% in addition to the drop at the open on Monday, what would happen to semiconductors, growth stocks, and the tech sector? It wouldn't have been 13%. Thus, with the Nikkei crashing, the VIX hitting levels that historically produce a very unattractive risk-reward ratio looking out several weeks, and just basically due to the uncertainty of the situation, we decided after the open on Monday to lock down some profits. Some nice profits. Yes, SMH had a big give back, but the average gain after the open on Monday was over 40%. The individual lots, 64%, 40%, and 37%. Similar situation with XLK. After the open, we locked down a gain of 28.36% on average when you look at the lots. SCHG growth, 23.18. The rationale here being, when you have a nice gain, if you lose the gain and we go into a protracted bear market, similar to the dot-com bust or the financial crisis, you may never be able to get that gain back. If you lock some of it down, they can't take the gain away from you. So the strategy was, we'll see how things unfold. Let's start taking some money off the table. We can always buy back if and when things calm down. Important notation here for clients about these returns. If you've been with us for any length of time, let's say 1 to 2 years, your numbers should look very, very similar to these numbers here. If not, your cost basis may have been different. Now, thankfully, very early in the session, things started moving into, that doesn't look as bad as you would have guessed. 9:51 a.m., this is XLK, this is the gap down on the open, this is a 1-minute chart, and you can see 1 minute into trading, XLK had buyers step in. At 9:51, it was at the session high, and as it turned out, at the close, this ended up being the daily low as well. We noticed this early in the session, and we cut this sell in half, and we cut this sell in half, taking the attitude, let's see how things unfold. So this is the first good thing that is potentially happening, because we don't know if this is going to hold, to offset some of this. Then the VIX intraday on Monday started to calm down. It's the second thing saying try to be patient. Remember we said on Sunday night when the Nikkei was down 6% that if we woke up in the morning and it was only down 3 to 4%, we'd classify it as no big deal? Another good way to gauge this was the Nikkei basically crashed. If Europe was crashing and Europe closes before the U.S., that would have told us something about the close on Monday in the U.S. from a probability perspective. Well, that's not what happened. In fact, at the close, as we noted on Twitter after the close, around lunchtime on Monday in the United States, this just looked like a regular risk-off day. That was another reason to say, don't get anywhere near the sell button right now. Conversely, if Europe ended up down 6 to 8 to 10%, we would have been more apt to take additional profits off the table on Monday. It didn't play out that way. Also noteworthy, remember the prior Friday, so Friday before Monday's panic sell-off, the stock market got hammered. But Monday, during the sell-off, again around noon, we noticed that Dow Jones Corporate Bond Index was up the prior week, closed near the session high, and closed above the 200-week moving average. That didn't scream imminent recession. To the contrary, that's a risk-on signal historically, something that occurred after the lows in 03 and 09. During the sell-off on Monday, again, around lunchtime, some more good news to offset the bad news. This report came in better than expected. Keep in mind, Monday was still ugly. The Dow finished down more than 1,000 points. Story dated Monday, August 5th at 9:22 p.m. Eastern Time. But as we looked at the charts in the afternoon on Monday, August 5th, during the big sell-off, you can see the S&P is down big in this image here. This still looked like a pullback within the context of an existing uptrend. We held in a similar area here in April, And these were important reference points here, the high at the end of 2023, the low in early January. And the market on Monday was still well above the anchored volume weighted average price line tied to the October low. And these are all relevant levels typically. Again, telling us to try to be patient. And some of these items that were not as bad as you might expect told us it was possible we were basically just seeing a lot of margin calls. And that's possibly why at the close on Monday, as outlined in this tweet, buyers did step in near logical levels. And it's possible that's why buyers stepped in very early in the session when markets gapped down in a major way on Monday morning. And during the session on Monday, it started to become more and more apparent that some of the big moves or big swings in the VIX could have been because there were a lot of lopsided bets betting on an extended period of calm. And when that started to unwind, there was a lot of short covering and a lot of margin calls. So between that and the yen carry trade, you get into somewhat of a negative feedback loop. You begin to believe that it's possible the big sell-off from the previous Friday after an NFP report that really wasn't that bad, and the massive sell-off on Monday doesn't necessarily reflect a major problem in the financial system or with banks or with the economy, or at a minimum, it was being compounded by short covering and a negative feedback loop. You can pause your video player and read more about it in this Reuters story or this Bloomberg story dated August 5th at 12:38 p.m. Eastern Time before the market closed. Fast forward to August 6th, right after the open, 17 minutes after the open, the VIX started to calm down. Here's the text from that tweet. The VIX hit an intraday high of 65.73 Monday. This morning, it hit an intraday low of 30.57. The only other times it has seen moves from 65 back to 30. A, 2009 after the financial crisis low, and B, 2020 after the COVID low. Again, taking some pressure off. And one of the factors that impacted the decision to take some profits off the table and get a little bit more defensive, that factor wasn't as concerning when the market opened on Tuesday morning. Still a factor, but not nearly as concerning, especially if the VIX stayed at tamer levels. And all of this is an example of maximum flexibility. When the futures open up on Sunday night, you have to keep an open mind. And during the day, when the VIX spikes to 65 and the markets are plunging, it's also important to try to notice subtle, that's not what I would expect pieces of evidence. And this one came literally a minute after the stock market opened. Here's a little blurb about the yen carry trade that you can read by pausing your video player, and a theory that the unwinding of the trade will be impacted by the performance of the U.S. economy moving forward and Fed policy. Again, you can pause and read. This implies that if the U.S. economy or U.S. economic outcomes are better than expected, it would take pressure off the markets. Even during Monday's session, when the market opened, bonds were up big, which looked like risk off, but it didn't last. 12:38 p.m. Eastern Time during the sell-off on Monday, bond ETFs flipped red. Here's the text from the tweet at 12:46 p.m. Eastern Time on Monday during the big sell-off. If the economy was heading for a dot-com or financial crisis-like deflationary recession, we would expect that numerous Fed rate cuts were on the way, and bonds would most likely be solidly green. At the moment, bonds are red to flattish. Now at that point, it gets very, very easy to move far, far away from the sell button, because this doesn't look like a market that's concerned about a dot-com bust type deflationary recession and bear market. This is what a deflationary bear market looks like with a recession, SPY relative to TLT. You can use any bond ETF you want. You're going to get similar results with IEF. When the S&P 500 peaked in October of 2007 here where the cursor is, the SPY TLT ratio made a lower high as the stock market made a higher high. This was a notable divergence, and it foreshadowed a horrible recession and bear market. So in the present day, if earnings are to hold up, as hypothesized in this tweet from August 8th, we would expect the market to hold up. And as of Thursday's close, the market was performing better than expected after the massive sell-off. In fact, as of Thursday's close, the low for the week in the S&P 500 was made 1 minute into trading at 9:31 a.m. Eastern Time, and that ended up being the low for the week. That does not look like large institutions that are selling into strength or trying to get out of the market. To the contrary, it looks like large institutions that are taking advantage of the gap down on Monday and trying to accumulate positions. Obviously, that's subject to change next week, but closing at the weekly high after this type of open on Monday, that can't be distribution. So if we want the yen carry trade situation to calm down, we would prefer to have the U.S. economy be stronger rather than weaker, and we would prefer that the present day chart not look anything like the chart on the left side of your screen. How does the same chart look today? Better, worse, or about the same? The answer is much, much better. Same ratio, right side of your screen, August 9th, 2024 at 10:44 a.m. Eastern. The blue box doesn't look anything like price action relative to the moving averages in the red box. And look how ugly the ratio was before the massive leg down in Q4 of 2008 and before Lehman Brothers collapsed in September of 2008. In the present day, we have a full-bore bullish look on the same ratio. Before Lehman collapsed, we're very, very, very close to a full-bore bearish look. And the ratio has been trending down for over a year. This really doesn't look anything like this. And like price action during Monday's session, it tells us a lot about expectations about future economic, earnings, interest rate, inflation, and Fed policy outcomes. As always, the commentary is based on the chart in front of us. If this chart over here starts to morph into something more like this, then we'll have to reassess those probabilities. Another thing that spooked the markets on Monday was the triggering of the Sham rule. You can read this article here. It too potentially is not as concerning as it appears to be at face value. If this triggered and the present day charts were concerning, we'd be concerned. When this triggers and the present day charts look like they do today, we take this with a grain of salt, file it in the keep an open mind filing cabinet, and move on. Back to the yen carry trade. It is relevant, and it is something that we need to keep an eye on. These are risk-off points up here, so if this reversed sharply, yes, it's relevant. But the correlation between the dollar-yen and the S&P 500, the weekly correlation is shown on your screen, and it is all over the place between 1982 and the year 2000, which means sometimes the stock market zigs when the dollar-yen zags, and sometimes the stock market zags when the dollar-yen zags. This is a nearly worthless correlation, and to give you some context, over the exact same period, this is the weekly correlation between the Dow Jones Industrial Average, aka the Dow, and the S&P 500. This is a strong, positive correlation. They tend to zig and zag together. Contrast that with this silly string correlation here. So this is relevant, but not necessarily a showstopper, something we will keep on our radar. And you can see during Friday's session, the dollar-yen was trying to make a stand near a logical level. And it's noteworthy that the dollar-yen at least is near an area of potential support. At the exact same time, the major markets in the U.S. and all of the major ETFs that we own, they all look very, very similar. They also are trying to make a stand near a logical level. There's a tweet about this concept in our Twitter feed at Shivako Capital on X. This is a gap, a gap, a gap. These are the anchored volume weighted average price lines tied to those gaps. You can see the market made a stand in December, in January, in April of 2024. The NASDAQ came on Monday morning at the open and overshot that level. which was concerning. But we know that markets tend to overshoot, and that's why you're taking a very small portion of your portfolio off the table, because you know overshoots are common. You have to start managing risk somewhere. You can't just keep putting it off indefinitely. This was a line in the sand for us. It was exceeded on Monday, and we took some reasonable and prudent profits off the table. And as you can see on the NASDAQ as well, the low for the week was made down here on Monday morning, approximately 1 minute into trading, and it closed very, very close to the weekly high here. Still has work to do, but if the uptrend remains intact, this is an excellent risk-reward entry point area here. We're not making any assumptions. So far, so good. It's fair to make an argument that this looks like this, and this looks like this, and is holding in a similar area like this. We'll learn something if price moves into this area next week after CPI. The longer it stays there, the more concerning it would become. It's not shocking that we came back to the trend. We were extended. We knew that. We talked about that. We were a little extended here. If for the most part you held your positions, they went on to make higher highs, and our account balances went on to make higher highs, just as they did after this correction in October of 2023. So far, so good. No assumptions. It's also good at the end of the week. The VIX, that was the high of this session on Monday during the panic, and we closed at the low for the week here on August 9th, are very, very close to the low. You can see the high in the previous charts was 65 and change. We closed at 2037 on Friday, August 9th. This is a 39-minute chart. This concept was in play on Thursday morning, and it was still in play at the close on Friday. Sometimes it can be very, very helpful to take a big step back. This is what a strong uptrend looks like in 2021 here. This is what a bear market and a downtrend looks like. This is what the S&P 500 looks like as of the close on August 9th, 2024. If we were taking a multiple choice test and took all of the emotion out of the equation, and the choices were, does this look like A, a strong trend all the way down, to D, a very weak trend, we would pick strong weekly trend and move on to the next question. And during the plunge on Monday and during this panic at the open, our friend Dean, Twitter handle up here, ran a study. Remember, we said that bonds opened strong on Monday. It didn't last. So the stock-bond ratio had a very rare move, very similar to the rare move in the VIX, a maximum fear type move. Similar moves, Dean going back to 1966. Average gain on the S&P 500 a year later, approximately 15%. The median gain, almost 16%. 92% of those cases, the S&P 500 was higher. The average max loss, the day of the signal, 5.2%, telling you to keep an open mind about Monday's low possibly being undercut. Not a prediction, probably not a high probability event, not a zero probability event. And the average max gain, approximately 16%. Simply telling us to keep an open mind about the possibility of the uptrend remaining intact and the market going on to make new highs sometime in the subsequent months. As we noted in a weekly video in late January of this year, on February 1st, we closed our new client window so we could focus on existing clients, the markets, and the Secular Volatility Research Project. And in late January, we estimated that we would complete the next major phase of the project sometime between late June and late August of 2024, and we're happy to report that we've met that deadline, and if anything, we might be a little bit ahead of schedule. So now let's talk a little bit about what we've been doing, what we've completed, and most importantly, how it can help us in the future. Tactically, the secular volatility model leverages 136 charts by answering 489 questions about market activity on multiple time frames, daily, weekly, monthly, and quarterly. The model is based on human greed and fear between 1950 and 1974, 1982, in 2002, 2011 to 2023. Now over to the left side of your screen. This phase of the project focused on December 28, 1956 to December 31st, 1968, and December 28, 2012 to December 31st of 2023. There's a reason we started in 1956 and into early 1957. So a quick refresher here for contextual purposes. Markets have a tendency to alternate between periods of secular stagnation shown via the orange boxes and periods of secular or long-term bullish trends shown via the green trend lines. From the low here in 1942, this secular bull lasted 27 years. From the low in 1974, this secular bull here, this is a 26-year window. And hypothetically, if something similar happened in the current secular bull, the long-term uptrend could last until 2034 or 2035. And since we've been in a secular trend for several years, it's good to have some understanding of where we might be in one of these cycles in 2024. So again, starting from this low in 1942, this low in 1974, and this low here in 2009, it's easy to make the argument that January of 2024 was similar to late July 1989 and similar to February 23rd, 1957. And if that's the case, we want to know how to manage risk and reward walking forward from late 1956 into the end of 1968. Since this window here, from point A here to point B here, hypothetically, could be similar to what we could experience between 2024 and this window up here. So conceptually, this window of the bull market is in the rearview mirror. This window of the bull market is in the rearview mirror. And the present day version started in 2009 to this point here. So we want to understand what it's like to walk forward for the remainder of this secular bull market. And we also want to know if we're drifting from the secular bull market script. If we can become experts on this window here, it could be very profitable, because walking forward from February 23rd, 1957 to Q4 of 1968, the S&P 500 tacked on an additional 149%. And we also said that January 5th, 2024 hypothetically is similar in terms of the secular trend window to July 31st, 1989, and becoming an expert on the market's volatility characteristics in this window could help us in the future, because the S&P 500 gained an additional 341% from July 31st, 1989 to March 24th of the year 2000. And going back to 1957, if we go to the highest high in 1974, the additional gain from point A here to point B up here was 177% in the S&P 500. And you'll notice there was a lot of volatility between point A down here and point B up here. And there's plenty of volatility here, 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 and into here. Thus, in order to focus on the bullet points in the lower left-hand corner of your screen, we manually scored by looking at charts and answering questions every week between the end of 1956 to the end of 1968, and every week between the end of 2012 and the end of 2023. And yes, we could have automated that process, but there's a visual component to this market. So if you tediously step through and review the charts and see how they change and evolve over time, it lets you understand how the model works in the real world. So in essence, we just traded the model between this date and this date and this date and this date and collected all of the data. So 1 week of data doesn't really fit on the screen, because the questions go from question 1 all the way out to question 489. And when you see the scope of the data, you'll understand the concept of time consuming. Data on your screen is data from one of the years that we scored. This is not the model. We're just showing hypothetically what the data looks like. So this is a week here going down. This is a week here. This is less than 1 year worth of data on your screen, expanding out over here to 52 weeks. So this is question 1 here down to question 93 on your screen. And if we zoom out, this is what 1 year of manual data looks like. And as you might imagine, when there's a lot of green on the screen, conditions are favorable. And when the amount of red starts to pick up, the odds start to slip. So from a scope perspective, this is 1 year of data. If we take that same data, this is hypothetically what 5 years of data looks like. This is what 12 years of data looks like. And this is what 24 years of data looks like. Hence, the time-consuming component. And if we were showing the 24 years that we scored, the patterns obviously would vary from year to year. We're just duplicating the same year over and over for illustrative purposes. Thus, since late January, we answered 489 questions for each week. There's 52 weeks in a year, and we modeled or collected data for 24 years. Thus, we answered 610,272 questions, allowing us to confirm that the prototype was giving us a good read and now giving us an outstanding tool to improve how we use that data. To provide some additional context, the weekly data here, a zoomed in look here, this data is used to calculate these scores. The scores allow us to take a snapshot of the market once a week and compare it to all of the historical data to help us better understand the market's risk-reward profile and ultimately a prudent allocation. And all of this data and some simple programming provides us with a tool to help us better understand how to leverage all of this on a day-to-day, or more specifically, week-to-week basis. Lower right-hand corner of your screen is December 31st, 2012. Left-hand corner of your screen is the end of calendar year 2023. The green line is SPY buy and hold, including reinvesting dividends. The blue line is the secular volatility model with an allocation containing ETFs that clients would recognize. Every single one of them we hold today. And the allocation tested here is very, very similar to our present-day allocation and similar to our allocations during risk-on periods in recent years, using the same ETFs that we've used in recent years. When we build this, we want to make it as realistic as possible, so it includes all the fees for the ETFs, and it includes the quarterly fees for CCM. And the goal is to build a robust model, a model that can be used in the real world. Not an ultra-optimized model that's difficult to use in the real world. Thus, as we continue to run what-if scenarios and learn more and more about prudently leveraging all of this, and all of this, and all of this, we'll continue to look for ways to incrementally improve the model based on these main objectives. We want to make sure when we look back in 5 or 10 years, if the markets continue to follow a secular path and are significantly higher, we want to make sure that we capitalize on a probable secular demographic opportunity. And ultimately, within the context of a secular trend, we want to reduce our trading frequency as long as the data allows. And each week, we'll be able to ask and answer. Does the data that we have in hand currently align with or contradict the secular trend thesis? And we'll be able to ask and answer based on the data that we have in front of us. Are we prudently allocated between growth assets, cash, and defensive assets? And we want to use the data and the model to prudently differentiate between normal drawdowns that occur within the context of a secular trend and a possible shift into a period of secular stagnation. And we'll cover some of these concepts momentarily with graphics. We want to employ a mitigation 1 tactic during the secular trend, and that ultimately allows us to segue to mitigation 2 if it looks like we're entering a period of secular stagnation. But given what we know today, and based on the data that we have in hand, we're still in a period we want to leverage the concept that secular bullish trends eventually, by definition, they make higher highs. And if we're not overtrading and we're not overreacting, ultimately that means higher profits and higher account balances. If we're not overtrading and we're not overreacting, ultimately that means higher highs and hypothetically higher account balances within the context of the secular trend. And we also want to reduce the probability of running into a problem that is extremely common with human beings, and that includes highly educated, well-meaning, and intelligent human beings. Fear of drawdowns and overreacting to 100% normal and to be expected volatility unquestionably tends to hurt performance. And if the stock market's up 6% in a given year, and hypothetically you have 50% of your assets in cash, you're probably up a lot closer to 3 or 4%. And over a 5 to 10 to 20 year period, that cash drag becomes very, very significant and puts a big drag on your net worth. We want to leverage the model to stay focused on the primary task at hand. All of this is about making money. And that's significantly different from trying to minimize drawdowns. If your primary goal is to minimize drawdowns, it's going to be very, very difficult to make money, especially big money over the next 5 to 10 years. And the concept of a drag from cash is covered mathematically in this story in the Wall Street Journal dated July 22nd. People have a tendency to roll over old 401ks and then just leave them in cash. And people have a tendency to keep a lot of cash on the sidelines in a money market or in CDs. Before we talk about what's coming next, let's talk about what we've seen in the rearview mirror. In the last several years, has the market been aligning with or contradicting the thesis that we're in a demographically driven secular bull market that could last for several more years? And have the events in recent years supported the creation of the CCM secular volatility model? And that ties in with bullet point number 1 up here. Short Takes post August 6, 2018 talks about changes in asset allocation, and that based on recency bias back in 2018, and many today are still in balanced portfolios. If you go back and look at the performance of tech stocks, the triple Qs, SPY, the S&P 500, the Dow, they have significantly outperformed bonds since August 6, 2018. If we looked at the performance of the stock market since January 31st, 2018, it's probably fair to say that demographics have played a role, and that demographics have had a significantly positive impact on the economy and markets. If you go back and look at the performance of tech stocks since Valentine's Day 2018, they've done quite well. Look at the performance of bond ETFs since February 16th, 2018 relative to stock ETFs. Bonds have been trounced. And everything that we know about asset allocation relative to the balanced portfolio has changed since August 3rd, 2018. And since August 30th, 2019, stocks have significantly outperformed bonds and gold. And we've talked many times in these videos over the past few years about the secular shift in interest rates and the secular shift in inflation, a topic that we've been covering for years on Twitter, and a topic that was covered this week in a CNBC article dated August 6, 2024. From that CNBC article, the economic policies of both parties are remarkably similar. Both favor large deficits despite a strong economy. We believe this supports our ongoing expectation of higher secular inflation in the coming years. And that's another reason why this window here is relevant. The 1950 to 1968 secular bull market was a period of rising inflation coupled with rising interest rates. And yet, the stock market did extremely well, albeit in the context of high volatility, which is why tools like this can be so valuable if the trends continue in the next 3, 5, and or 10 years. I think it's probably fair to say, since we posted this on October 18th, 2019, the S&P 500 has exceeded expectations. And it's probably fair to say, based on the expectation of the average market participants, stocks have exceeded expectations walking forward from June 16, 2023. And if you want to better understand the impact of demographics, you can Google our last name, Shavako, followed by demographics. This link, left side of your screen, will take you to an article with charts and tables. If you prefer videos, you can use this link here or this link here. The evidence is logical, and it's powerful, and it's easy to understand. Before we link back to how the secular trend model works, the base case, which is contingent on market conditions, is to begin contacting prospective clients on the new client window list sometime in the next 10 days. You can expect an email. We'll start with the first person on the list and work our way to the last. Since we have more work to do on the secular volatility model, this is a tactical window meant for those with serious interest, people that have been watching the videos for a long, long time, and for the most part have made a decision to become a client of Shivako Capital Management. We'll try to make it as easy as possible for you to get set up, respecting your valuable time, and we're happy to answer any tactical questions you may have. If you're not on the list and you'd like to do so, we will probably keep that window open for another 2 to 4 weeks, and then we will close the new client window, allowing us to begin the next phase of the secular volatility research. We'll most likely talk about the next phase in subsequent videos. Once that phase is complete, it is possible that we will reopen the new client window. It is also possible that we will not reopen the new client window. That's to be determined. Who's a good fit for the secular volatility model? Typically, it's somebody that's worked hard for a very, very long time, or a family that's worked hard for a very long time. They've invested wisely, and they've accumulated some wealth that they're not interested in seeing erode at this or this type of rate at any point in the future. At the same time, they want to prudently participate when the odds are in their favor and within the context of a secular bull market. Let's quickly revisit some of these concepts. There's a portion of the period that we just finished studying. It's a portion of the secular trend in the S&P 500 that started in 1950 and for the most part ended at the end of 1968. If you tried to navigate between point A in the lower left-hand corner of your screen and point B up here, and you were overly concerned about drawdowns, that was a difficult task. Because when we say the median drawdown was 10%, and the average drawdown was 13.82%, that implies there were some larger drawdowns. But the reward between point A and point B historically was significant. The S&P 500 gained an additional 170%. But as we all know, all good things must come to an end. And the market quickly wiped out years of gains, dropping approximately 36%. It rallied strongly into early 1973, and then the 1973-74 inflation-induced bear market destroyed a lot of wealth. The S&P 500 dropped 48.2%. This is an 11-year window in here where the market went up 170%. That's within the context of the secular trend. And the reason why we're implementing a mitigation 1 strategy that in some cases may actually harm performance in this window, it gives you a head start when the secular trend ends, and one of these drawdowns turns into a drawdown like this. If you already have a high cash position up here, it's much easier to mitigate some of this final drop. If you're 100% invested in here, it becomes very, very difficult. In the blue box, mitigation 1, when the data starts to deteriorate, and we get in one of these red boxes, the model shifts to a mitigation 2 strategy. Basically saying we're willing to raise significantly larger stakes on the conservative side of the portfolio. Cash, bonds, gold, what's ever trending or attractive at the time. If you fit this type of profile over here, all of this is important because psychologically it's very difficult when you walk forward from this point here, upper right-hand corner of the blue box, and the market drops 48% and your net worth relative to your investment portfolio takes years and years of patience and diligence and brings your portfolio back to a level most likely that you never thought you were going to see again. In terms of the S&P 500 index, we can draw a horizontal line from this point here in 1961 and hit this point here in 1974. Thus, during the secular trend, right side of the screen is our primary goal. Mitigation 1 respects that drawdowns are absolutely going to occur, and some of them are going to be gut-wrenching. See calendar year 2022. But in every case, within the context of a secular trend, the S&P 500 eventually went on to make a higher high. And there's a wealth of information that you can find on our website using the site menu in the upper right-hand corner. Thus, this is a great study from Sentiment Trader. Jay from Sentiment Trader also had a great study. You can find it on his Twitter feed. Again, a max fear type study. Equity put call ratio after similar instances in the past. 1 week later, the S&P 500 was up 1% typically. 2 weeks, almost 2%. A month later, almost 4%. 2 months later, 4.7%. 3 months later, 6.2%. 6 months later, 9.5%. 1 year later, almost 15%, with 92% of the cases positive. Returns in the box here are median returns, the full table down here. Jay's Twitter handle here. How about secular volatility scores? We know they've been very, very high, and we also know that at some point they're going to weaken during a 100% normal and to be expected correction. That did happen intraday on Monday. These scores are during the sell-off. You can see these numbers here and here, notably different from these numbers here, July 25th. But it's a weekly model, so the weekly close is the relevant number. And you can see we clawed our way back, and these are still very strong numbers on a relative basis. Also noteworthy in terms of keeping an open mind. If a massive recession was right around the corner, we would not expect TLT to underperform SMH, economically sensitive semiconductors, for 4.85% for the full week. And we would not expect defensive consumer staples to underperform the S&P 500 for the full week. This is what an uptrend looks like. This is what a downtrend looks like. This is what a downtrend looks like. Right now, this looks like a counter-trend move within the context of an existing downtrend, a counter-trend move within the context of an existing downtrend. No assumptions about what next week looks like. These are the charts in front of us. This should also jump off the page. Is the market wildly extended as it was in 1999 or the year 2000? It is not. In fact, it's still very, very close to a 2-year base. The further you get extended from a base, the riskier it becomes. If we came back in this direction, this would be potential support, strong potential support. This looks like a strong uptrend that just broke out of a 2-year base that could potentially run for another year or so, possibly, before something like this. And all of this occurred within the context of an existing secular trend. Remember, secular trend doesn't mean easy. You can pause your video player if you want to look at these summary bullet points. If you're interested in becoming a new client, there's details about investment minimums on our website under minimums. The one account minimum is a firm minimum of $500,000. And remember, this window is for prospective clients that for the most part are ready to go or are very close to making a decision. Stocks made a stand near a logical level this week. Thus far, there's little damage to the long-term trends. History and the charts in front of us tell us that tech and growth could resume their leadership, as they did this week. And the signals and studies that we presented said we're currently at a very favorable risk-reward entry point, potentially, based on the charts that we have today. And we all know the only way that any of this can work is that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.